Decoding Financial Health. A comprehensive guide to assessing company stability through its balance sheet. Introduction. In the intricate landscape of financial analysis, the balance sheet emerges as a crucial document that serves as a financial compass for investors seeking insights into a company's stability and fiscal health. By meticulously examining the components of a balance sheet, investors can unravel the financial narrative of a company, discerning its strengths, vulnerabilities, and overall viability. This comprehensive guide explores the multifaceted ways in which investors can assess the financial stability of a company through the prism of its balance sheet. The balance sheet unveiled. A balance sheet, often referred to as the statement of financial position, provides a snapshot of a company's financial condition at a specific point in time. It is divided into two main sections: assets and liabilities. The fundamental accounting equation, assets equals liabilities plus equity, forms the backbone of the balance sheet, highlighting the equilibrium between a company's resources and its financial obligations. Understanding the asset side. The asset side of the balance sheet encapsulates a company's resources and investments. Investors can gain valuable insights by delving into the specific categories of assets, including current assets such as cash, accounts receivable, and inventory, as well as non-current assets like property, plant, and equipment. Examining the composition of current assets is crucial, as it sheds light on a company's liquidity and short-term financial health. For instance, a high level of cash and receivables relative to current liabilities signifies robust liquidity, reducing the risk of short-term financial distress. On the other hand, an excessive reliance on inventory or slow receivable turnover may raise concerns about operational efficiency. Non-current assets, such as property and equipment, offer insights into a company's long-term investment strategies. Depreciation schedules and impairment assessments are key considerations, allowing investors to gauge the sustainability of these investments and their potential impact on future earnings. Deciphering the liability landscape. Liabilities, the financial obligations a company must fulfill, are equally instrumental in evaluating financial stability. Current liabilities encompass obligations due within 1 year, including accounts payable, short-term debt, and accrued expenses. The high ratio of current liabilities to current assets may indicate potential liquidity challenges, necessitating a closer examination of a company's ability to meet its short-term obligations. Non-current liabilities, such as long-term debt and deferred tax liabilities, unveil a company's long-term financial commitments. Investors must assess the terms, interest rates, and covenants associated with long-term debt, discerning the potential impact on cash flows and overall financial flexibility. Equity, the residual interest. Equity, representing the residual interest in a company's assets after deducting liabilities, is a crucial facet of the balance sheet. Investors often scrutinize the composition of equity, including common stock, retained earnings, and additional paid-in capital. To understand the sources of a company's capital and the returns distributed to shareholders. Retained earnings, accumulated over time through profitable operations, provide insights into a company's historical financial performance. Positive retained earnings reflect sustained profitability, while negative retained earnings may suggest accumulated losses, warranting further investigation into the factors contributing to the deficit. Ratios and metrics for in-depth analysis. Beyond a qualitative examination, Investors employ various financial ratios and metrics derived from the balance sheet to conduct a more nuanced analysis of a company's financial stability. The current ratio, calculated by dividing current assets by current liabilities, offers a snapshot of short-term liquidity. A ratio exceeding 1 indicates that a company possesses more current assets than liabilities, signifying a healthy liquidity position. The debt-to-equity ratio, comparing a company's total debt to its equity, aids in evaluating the level of financial leverage. A high debt-to-equity ratio may indicate a higher degree of financial risk, as the company relies extensively on debt financing. Conversely, a lower ratio suggests a conservative capital structure. The quick ratio, a variation of the current ratio that excludes inventory from current assets, provides a more stringent measure of liquidity. This ratio is particularly relevant for companies with slow-moving inventory, offering a more accurate gauge of their ability to meet short-term obligations. Cash flow metrics, derived from the cash flow statement but closely tied to the balance sheet, complement the assessment of financial stability. Operating cash flow, the cash generated from core business operations. And free cash flow, representing the cash available for distribution to investors and debt reduction, offer valuable insights into a company's cash-generating capabilities. Red flags and warning signs. An astute examination of a balance sheet can unveil red flags and warning signs that warrant careful consideration. Sudden increases in accounts payable, a deteriorating current ratio, or a spike in long-term debt may indicate underlying financial challenges. Significant changes in equity structure, such as a sharp decline in retained earnings, merit a closer look to understand the factors driving these shifts. Industry comparisons and benchmarking. Assessing the financial stability of a company through its balance sheet gains additional depth when contextualized within industry benchmarks. Each industry exhibits unique financial characteristics, and investors should compare a company's balance sheet metrics to industry peers to identify outliers and gauge relative performance. Conclusion. In the intricate dance of financial analysis, the balance sheet emerges as a foundational document that empowers investors to unravel the financial narrative of a company. Through a meticulous examination of assets, liabilities, and equity, investors can discern the nuances of a company's financial stability, uncovering vital insights that inform investment decisions. Armed with a comprehensive understanding of the balance sheet, investors navigate the complex terrain of financial markets with clarity, equipping themselves to make informed and strategic choices in their pursuit of sustainable returns.